China has been the protagonist of one of the most astonishing economic miracles in history, achieving rapid growth and transforming itself from an impoverished nation into a global economic powerhouse. However, it has now begun to show its first signs of weakness. The average GDP growth rate in China has dropped from over 10% to less than half of that in recent years. Increasing political instability, a well-known real estate crisis, and the ongoing tariff war with the West do not forecast a promising future, prompting the question, is the Chinese economic miracle coming to an end? It's not a far-fetched notion, especially when one considers the striking similarities between China's current situation and Japan's economic trajectory in the 20th century. China's recent economic history is almost a replica of what happened with Japan in the latter half of the 20th century. Both countries started from being extremely poor and then opened up to markets and globalization, leading to prosperity that threatened U.S. hegemony. In the past, Japan dominated the automotive sector with companies like Honda and Toyota, and the tech sector with companies such as Sony, Nintendo, and Panasonic. These Japanese companies once outperformed American firms and even jeopardized the U.S. semiconductor sector monopoly in the 1980s. In response, President Ronald Reagan imposed harsh tariffs and quotas on Japanese technology to protect American industry. This situation mirrors what Donald Trump and Joe Biden have done with Xi Jinping's regime, with trade wars and tariffs aimed at curbing China's technological advancements. Another critical factor that led to Japan's economic slowdown was a massive real estate crisis in the 1990s. This real estate bubble's burst marked the beginning of Japan's lost decade, a period of stagnation that saw Japan's economy fall from the second to the fourth largest globally. Given the parallels, the question arises, does China face the same fateful destiny as Japan? Is the Asian giant on the verge of stagnation? Hello to all the community of Finance for All, welcome to another video. There are at least three major issues threatening China's development: the real estate bubble, the trade war, and state interventionism. These issues were also present in Japan, but let's delve deeper into each one. China's real estate bubble is arguably the largest in history. Its investment in the housing market has even surpassed that of the United States during the peak of the 2008 financial crisis. Some estimates suggest that China's real estate sector is twice as economically significant as that of all Western countries combined. The problem is not just the sheer number of homes being built, but that they are being constructed in locations where they are not needed. About 80% of buildings constructed in recent years are in small cities that are losing 2% of their population each year. This has led to a surge in purchases of non-primary residences, meaning homes that often remain vacant. Speculation is the main driver here. Chinese investors typically avoid stocks or financial assets, preferring to invest in real estate. This creates a substantial bubble risk, similar to what happened in Japan. In Japan, the bubble's origins were somewhat involuntary. The Japanese government kept the yen's value low to promote exports, a strategy that worked well until the Plaza Accord of 1985. This agreement forced Japan to appreciate the yen, which significantly harmed its exports and led to an economic shock. To counteract this, Japan's government increased public spending and lowered interest rates, inadvertently creating a stock market and real estate bubble. The burst of this bubble in the 1990s had severe consequences. In China's case, the bubble was deliberately inflated by the government, particularly under President Hu Jintao. When he came to power, China was becoming the world's factory, heavily reliant on international trade. However, the 2008 financial crisis showed how vulnerable this made China, as the country was significantly affected by Western financial troubles. To reduce this dependency, China's government shifted focus to boosting the domestic economy, heavily investing in the real estate sector. The state poured money into developers and construction companies, leading to the massive bubble we see today. Unlike Japan's relatively short bubble, China's has been growing for over a decade, fueled by state intervention. The trade war between the United States and China echoes the trade conflicts between the US and Japan in the 1980s. Reagan's administration forced Japan to strengthen the yen and impose tariffs to protect American industries. Japan accepted these conditions due to its dependence on the US for military security. Despite these restrictions, the Japanese economy suffered significantly, but it did not result in a generalized collapse, as Japan's technological sector was already highly advanced. Companies like Nikon, Toyota, and Fujitsu were at the forefront of their industries, making Japan a tech powerhouse. China, on the other hand, still heavily relies on Western-aligned countries for critical technology and components, such as microchips. Companies like ASML provide essential technology for manufacturing microchips, and China depends on these supplies to sustain its tech industry. Additionally, China produces a large volume of mass consumer goods, like electric cars, which require a vast international market. The current trade war could potentially harm China more than it did Japan, as China's technological sector is not as self-sufficient. The trade restrictions could severely impact China's ability to compete globally, especially if the US continues to ramp up tariffs and other trade barriers. Both Japan and China have struggled with state interventionism in their economies, leading to the prevalence of so-called zombie companies. In Japan, these were known as kiretsus, large corporate conglomerates centered around a financial institution like a bank. These companies were heavily supported by the government with low-interest loans, leading to massive debt levels. When Japan's economic growth slowed and cheap loans ended, many of these kiretsus collapsed, causing a significant contraction in the Japanese industry. In China, state-owned enterprises and state-owned banks still dominate the economy. Since Deng Xiaoping's era of opening up, the Chinese government has relied on large industrial organizations to expand economic capabilities rapidly. These state-owned enterprises are often inefficient and heavily indebted, similar to Japan's kiretsus. Chinese state-owned banks, which control over 50% of the country's financial assets, have been used to support these enterprises, especially in the real estate sector. This has created a plethora of zombie companies that depend on government assistance to survive. Without this financial support, many of these companies would collapse, potentially leading to a severe economic crisis. A significant issue facing both Japan and China is population collapse. Japan was one of the first countries to experience an aging population and a declining birth rate, which contributed to its economic stagnation. The reduction in the working-age population led to slower economic growth, as fewer workers were available to sustain the economy. China faces a potentially more severe demographic decline due to its one-child policy, which was in place for over 30 years. This policy aimed to control overpopulation but has resulted in one of the most significant demographic collapses in history. The aging population and declining birth rate could severely impact China's economic growth, as the workforce shrinks and the burden of supporting an elderly population increases. Despite these challenges, there are reasons to be optimistic about China's future. Unlike Japan in the 1990s, China still has significant growth potential. The country's lower level of urbanization and per capita GDP suggest there is considerable room for economic expansion. China's higher interest rates also give the Bank of China more flexibility to adjust monetary policy and stimulate growth. China's private sector remains relatively dynamic and less burdened by the inefficiencies that plague state-owned enterprises. This could allow the private sector to drive economic growth, even as the public sector struggles. Additionally, China controls extensive global supply chains, giving it a level of economic integration and influence that Japan did not have. The similarities between China and Japan's economic trajectories are striking, but there are also critical differences. China's more dynamic private sector, significant growth potential, and greater policy flexibility might help it avoid Japan's fate of prolonged stagnation. However, the risks posed by the real estate bubble, trade war, state interventionism, and demographic collapse are substantial. Whether China can navigate these challenges successfully or follow Japan into economic decline remains to be seen. This discussion prompts further reflection. Considering the similarities and differences between the two Asian economies, is China truly headed for stagnation, or can it chart a different course? What do you think? Share your thoughts in the comments section.